right, great. We'll directly jump into the next session or Fireside chat. So my name is Nathan DeRuiter. I'm the Managing Director at Euroconsult. And I'm very pleased to be joined here today by Chad Anderson for a Fireside chat on the investing in the new space age. So Chad Anderson is the founder and managing partner of Space Capital, where he has been pioneering investment in the space economy for over a decade. He was really one of the first to recognize kind of this commercial space opportunity and, for the space sector. And the previous panel talked quite a bit about how much investment has been gone into the space sector recently. He's also an author of a great book. It's called The Space Economy, Capitalize on the Greatest Business Opportunity Over a Lifetime. If you definitely want to learn more about the space economy, it's a highly recommendable book to get a good understanding. So before joining Space Capital, Anderson led a successful career at JP Morgan Chase, where he managed a $50 billion real estate portfolio. Described by TechCrunch as among the best positioned people to weigh in on a current and future state of the space startup industry, I think Chad is a perfect guy to understand how to navigate and invest in the space economy. So Chad, thank you for joining. We'll do a Q&A. I will also open up the floor for people to ask their questions, so please free to jump in and join the conversation. So first question, Chad, I would like to kind of come back to your Space Capital tracks the space investment on a quarterly basis. And I understand that the Q4 2023 results are about to release shortly, so maybe you can give us a sneak preview or some kind of role exclusive on how it's going to look like.
Yeah, sure. And thanks for having me. Hi, everyone. Good morning. Happy to be here. So our Space Investment Quarterly, we've been investing in this category for over a decade. We've been aggregating information about startup activity and investment trends over that entire period. And that's been really important for us to sort of get our arms around the opportunity and help us segment the opportunity and understand it better. But that's also really helped us to help educate the financial markets and the capital markets to understand what's going on and where the real opportunities are. So this has been a really valuable data set for us. We've been tracking it for a decade. We've been publishing it since 2017. And the year-end reports are always the most interesting to see sort of like, where the year ended up and to give us some time for reflection and also looking forward. So so it's going to be coming out in the next few days, and really, 2023 was a really tough year for startups. I'm sure you've heard that in every panel that you've been in at this conference. The collapse of Silicon Valley Bank, a wave of down rounds across venture and across stages, particularly in growth and late stage, mass layoffs. It's been a difficult year for startups and for fundraising, but it's also been a year of extraordinary growth in the space economy. This is driven by a few things. We've seen record launch activity globally. We have seen a lot of that driven by SpaceX, accounting for nearly half of all the launches globally, and they're ramping things up even more this year. Advancements in AI are accelerating growth across tech, and that includes the space economy. It's been another extraordinary year for space.
Yeah, so clearly the sentiment has overall in the investment climate changed. The previous panels touched on it, but do you see, if you look from quarter to quarter, some signs of recovery or some sign of improvement throughout 2023?
Yeah, I think in stark contrast to where we started this year, there's actually a lot of reasons to be optimistic about this year. Inflation is under control in the US. A lot of people expecting rate cuts this year. Public markets are responding and they're near record highs. So there's a lot of reasons to feel optimistic about 2024, not to mention the fact that there is a lot of government demand. So in a market where this last year, the market's been really tough because enterprises have been really, the purse strings have been very tight. They haven't been spending on SaaS products like they have in the past. So a lot of the large growth stage companies have really struggled to find revenue. And in a market like this, government dollars go a long way. So because there's been such strong, consistent demand from government, which makes, which is a large customer of space services and products, 2023 was, ended up being a very decent year, and that bodes well also because now you're going to get the combination of continued government interest and government demand, increasing revenue from governments, but then also I think we're going to see some of the enterprises like loosen up their purse strings and start to purchase again.
Great. Yeah, and I think, beyond numbers, obviously, there's also this kind of strategic trends. In the previous panel, talked a little bit about it, about, the increasing focus, I would say, to kind of defense as a kind of our government customers' path to profitability, the typical things. Do you have seen kind of these shifts in kind of the investments, either, from the type of companies you invest in? I know you track as well, like more upstream or downstream. Is there you see a bigger trend in terms of where the money is flowing in the past few months?
Yeah, absolutely. So applications makes up a large portion of investment into the space economy, a large portion of activity, commercial activity, and revenue and investment, and applications is where a lot of the value aggregates. And so, it makes up 3/4 of all investment into the space economy over the last 10 years. This year, applications fell off a cliff. And every quarter we've been saying the same thing. It's like, wow, this is really a low quarter. This is really a low quarter. And that continued into Q4. So applications had a very, very, very rough year. This is, think SaaS, think location-based services, all the GPS applications that we know and love. They really struggled to raise in this environment because, again, they were struggled to generate new revenue from enterprise customers. And at the same time, they were trying to grow into their valuations that were frothy from a couple of years ago. So applications fell off a cliff, but infrastructure was very strong. And this is kind of a little bit counterintuitive because you'd think that in a market like this, everyone would be going to software. But actually, it's the space infrastructure that has proven to be incredibly resilient. And again, a lot of that comes down to government dollars. In a market like this where revenue is scarce, everyone is chasing government dollars. Every VC is out there. I mean, if they're not talking about AI, they're talking about defense, and probably both. Everyone is now, defense companies have traditionally been ill-suited for venture dollars. That's been like sort of common approach. They've shied away from it. But now, in a market like this, it's really driving everyone to chase those government dollars. And so you see everyone talking about defense. At the same time, governments around the world are waking up to the fact that space technologies and space infrastructure are critical to national security and economic stability and economic growth. So more government dollars are driving a lot of infrastructure, growth in infrastructure, and actually also in emerging markets in some of these new areas, driven by Artemis programs and increasing traffic in space and all these things.
Yeah, but then if we move the discussion a little bit to the space economy in general, if you look at the numbers, obviously most of the value is still driven by consumer kind of market, right? If you look at the GPS that we use in our phones or other it's kind of driving what the value is about. If you look at the connectivity part, it's Starlink nowadays, but if you go back to broadcasting, it's like if you take the overall, let's say 400 billion plus space economy, a big part is driven by those markets. So here at CES, obviously we're kind of interested in looking forward. Where do you kind of see, where space technology can really enable kind of untap this new consumer market that kind of really can grow the space economy at a kind of spectacular, more aggressive rate? So what do you, if you take like maybe top 3 opportunities for, matching satellite technology, unlocking new consumer market opportunities?
This is a fun one because kind of speaks to why we're here. We don't really do CES. We haven't in the past. But I think there's a lot of opportunity to talk about the link to consumers, because primarily what we're investing in is enterprise and government, B2B and B2G. That's where a lot of our focus is. But the fact is that applications make up a huge portion, an outsized portion of activity in the space economy. we use it every day. GPS helps us go, get where we're going. It powers our financial markets. Positioning is incredibly important to the modern global economy. Space technologies are the invisible backbone of our economy. And so, but it's really, so GPS is the most successful space technology in existence. We all know it. We all love it. It helps us through our everyday lives. There's also a lot of opportunity there to get more precise, and to enable new applications that require precise positioning, like autonomous vehicles, like augmented reality, layering digital information on top of the physical world, and then being able to accurately advertise or navigate or what have you. So in GPS, this is the most mature of the areas in the space economy, and the most successful. And I think there's still a lot of opportunity for that area to grow. In geospatial intelligence, right? So if GPS is the dot on the map, geospatial intelligence is the map. And we're really interested in taking the base map and layering digital information on top of that. A lot of that valuable information comes from satellite imagery, particularly at a global scale. And there's been a lot of demand from that from governments over the last couple of years. And also a growing demand for enterprises as we remove the barriers to entry and make it more easily accessible. So company in our portfolio is aggregating data from all of the different data providers, structuring that data and making it really easily accessible through an API, the Skywatch API. And that's enabling companies enterprises to then come in and tap into that API and figure out how they can build it into their work streams. So we're going to start to see that roll out to enterprise applications and then also to consumer applications, and it's going to enhance our way of life, just like GPS has. And then the third one, and probably the biggest opportunity on the consumer side, is satellite direct to cell. So we kind of got there right at the end of last year. SpaceX launched a couple of their first satellites that are going to go direct to cell. They've turned them on and tested them already in the first couple of weeks of this year. There's several other companies that are doing something similar. Iridium has just announced their approach to this. Direct to cell is a massive market. And if you think about Starlink and the capability of Starlink and the ability to, you will have a cell phone that is connected always, regardless of where you are, out in the middle of the ocean, at the top of Mount Everest. It doesn't matter. Like you don't need to worry about how many bars you have. From a consumer perspective, that's really interesting, the types of consumer applications that it unlocks, and also on the enterprise side, industrial, IoT, remote operations, connected living in homes in remote areas, getting us back out into nature, and also staying connected at the same time. I mean, I could go on and on. This is a massive opportunity.
It's great. Actually, the next session will exactly about this topic. So please, people, stay for that one to learn more about it. We just have a few minutes left, so I do want to give the opportunity to the audience. If you have any questions for chat, please raise your hand. Yes. I'm not sure we have the microphone, or I speak up loud. Yeah.
So it looked like your fund raised about $100 million. Are you worried about more money? Like just what's the appetite? What's the interest? How hard was it to raise the fund? Have you started the next one? I guess how much excitement is building around it? Because in a lot of ways, it's a lot of money. In a lot of ways, it's really not a lot of money. So just curious on your sentiment on that. Obviously, still something to be proud of.
Thanks. Yeah. So from a public markets perspective, or like growth stage or late stage venture, right? We're small. We're small by design. We're focused on seed stage companies, so we're investing $2 to $3 million as the first institutional check into a company. So for us, this is right sized. We're closer to 150 million now. That's spread across 3 funds. We're actually raising and deploying Fund 3 as we speak. So we have been fundraising throughout the last 12 months. Similar to what's happening with startup companies, it's also been a very challenging environment for venture funds. We're in a liquidity crunch where companies, funds are not investing into net new companies. They're prioritizing the companies that are in their portfolio, which makes it difficult for early stage companies to then graduate. And so we're going to see, it's a difficult market. It's going to continue to be a difficult market this year. We have seen companies fail. We've seen companies get rolled up and acquired. We're going to see more of that. We've seen the number of funds also in 2021 went from like 2,500 to 5,000 globally, and that's now come back down to like 3,000 funds. So a lot of companies, the weakest companies, have not made it. Some were struck by just bad timing in their fundraising efforts, but for the most part, like this is a healthy sort of recalibration of markets. At the same time, there was a lot of funds that raised capital. A lot of people raised specialist funds with no specialist experience in the area in which they were going to invest. Those funds are going away. I think all of that's really healthy. But what I will say is that companies, even in this market, it's either you're not getting a term sheet and you're not pulling around together, or you are killing it. You've got something that the market really wants and you're swimming upstream very effectively. You get a term sheet and then everyone piles in and it's like everything's either not happening or it's massively oversubscribed. So a lot of companies in our portfolio are actually doing quite well. They're tapping into the government dollars over the last year or two that have been increasing, and so our portfolio is performing very well. And so the strongest companies are going to make it and going to thrive, and our fundraising has been successful as a result. So I think that's kind of like the common theme is the weakest will not survive and the stronger will.
I feel like the right size for where you want to be in seed funds.
Oh, absolutely, yeah. I mean, the idea is to stay, we're small by design. I mean, the idea is to stay small in perpetuity. Me and my partners, we like investing at seed. If you raise larger amounts of capital, then you naturally have to start going later and later and then doing Series A and Series B. And that's just a fundamentally different proposition. We've built our fund to be really good at sourcing, evaluating, and supporting companies at seed. So we want to continue doing that.
Good, great. Our time is up. I think Chad will be still a little bit around here for a few minutes, so if you have some questions, please make sure you see with him. We're just directly going into the next session, so I would like to ask my colleague Sumaya Narjarali to come here to the stage and join our speakers for the next session on the direct to sell opportunity, which Chad already spoke a little bit about. So thank you, Chad.
Thanks very much, everyone.